Matrix trade. Matrix is a new, innovative approach to macro trading, looking at the foreign exchange markets. No, you did.
I'll do it.
Yeah. Stock indices and commodities. Essentially using evidence-based analysis. I'll take over, Dave. It's going to be much easier for you.
I would have thought so. Yeah, right arrow.
Evidence-based. When I say evidence-based, I mean essentially looking at markets from what they do, typically what they've done before, looking at what really drives the market to arrive at some sort of historical analysis that's got proof behind it. And from that proof, we can derive a trading strategy, not just to identify what we think is the best trades based on the analysis, but where the analysis has been exactly very similar, and to come up with the right trading strategies. And from that, we have an approach to markets which can be educated and can be taught to people. So let's assume there were an earthquake today. The first thing, obviously, it's possibly a bad taste example, but it serves a point. We'd obviously pray for all those sadly affected. Also, we shouldn't panic. As traders and analysts, we can't afford to panic. We need to prepare. And as Charlie Munger, Warren Buffett's right-hand man, said, when asked what they did to arrive at their strategies, it was prepare, prepare, prepare. And once you've done that, you can proceed and then hopefully profit. So, the title of today's talk is what really moves the market. Now, if I would ask each and every one of you what moves the market, I would probably get about 80 different answers. And the thing is, we'd all be right at some point. The question, though, the point is that you wouldn't be right all the time. So the question then becomes, what causes markets to move? And the best answer to that is proof. What's moved the market before? The evidence for why you were right and why you were wrong, and the history is the answer. Price determines the answer. Which comes to the point where some of you will know that I'm a pioneer of something called fractals. It sounds very mystic, but essentially a fractal is a piece of price action that can be compared or identified with previous price action. Sounds mystic or wonderful or whatever, but our lives are based on fractals, on an approach that the sun rises in the morning and goes down at night, something in history repeats itself in identifiable patterns. So, what if there were an earthquake? When we look at the history, look at the evidence, what happened in the 3 major earthquakes this century in Japan? You can see to some extent it's at the end of a long-term downtrend, momentum loss is increasing. What would you do if there's an earthquake in Japan? Yeah, exactly. You would sell yen. This is a dollar yen chart. You would buy dollar yen. What? And would you be right? No. Don't know about 1923, but in 1995, you can see what happened immediately. There's an earthquake. Everyone would expect dollar yen to rally. As a result, it went down. One of the main reasons why 1995 was so violent is because of someone called Nick Leeson who happened to lose his bearings. Apologies for the poor taste joke. Our sympathy goes out to Nick. But some event in 2011 with the earthquake. So, what are we going to do now? We're stuffed. Are we going to buy more, add to a losing position? Of course we are, because we're trading in retrospect. We know what happened in 2011. Yeah. That's right. Back to the top of the ranges in the last 2 cases. Take time to take profit, yeah? Or maybe even sell. It's what a lot of people did. Move that large. We hadn't seen a move that large for a very long time. So you sell into that. No. Oh, okay. Well, we're going to average into that? No. At this time, what you're seeing, the reason for the initial rally is that with the earthquake, the Japanese government is going to have to fund the reconstruction. They have to buy bonds. What we're seeing across the board then, at the end of this downtrend, we're seeing the JGBs rallying, we're seeing the Nikkei rallying. It's essentially like a war scenario where the market is buying aggressively. So although the retail market was selling at some point within that, you saw some major fund buying of dollar yen, buying dollars that wouldn't come back into the market in too much of a hurry. And it carries on going. Forever? I think one or two people mentioned previously about Head and Shoulders may have used this last example. At the end of it, what some would argue a 5-way trend sequence, where what you're seeing within this is start seeing the real buying start slowing up. You see the fundamentals start to deteriorate, even though the market is still rallying. Head and Shoulders in 2 of those cases, just as you saw them at the bottom, whack. 3 earthquakes, different times of the century, and yet the same type of thing happens. So you have to ask yourself why. And the simple answer is that not identical, but similar things happen in terms of what was really driving the market. So what really moves markets? Fundamentals. May sound odd coming from someone who was one of the first technical traders of foreign exchange in London, but I did come out of Oxford with an economics degree, so I did attempt at least to start with the fundamentals, but realised very soon that you can't be right in the wrong market, that you can't rely on fundamentals alone. And that markets, the fundamental links between markets can often drive them as well. But coming back to technical analysis, a lot of people here and historically have relied on it as a map to where the markets will really go. So it's people buying and selling based on these 3 influences, and therefore it arrives at sentiment. So by sentiment, I don't just mean you and me, human traders, but also algorithms. What's happened?
From what map? Effectively.
Since 2008, talking about sentiment, a lot of people have talked about what drives a market is human emotion, people buying and selling driven by fear, greed, hope and aspiration, and because maybe they need to buy the wife a big Christmas present to say sorry or whatever. But also since 2008, we've seen an explosion in high frequency algorithmic trading machines, if you like. But they also add to sentiment in that their data originally was based on sentiment, human sentiment driven markets, but now they necessarily repeat themselves. They're logically programmed to do the same type of thing in similar circumstances. So if you can identify what they've done before, they're likely to do it again. You don't need a black box to work out an HFT-driven market is likely to repeat itself. By fundamentals, when I say fundamentals, I mean the real world, whether it appears closely or remotely connected to what is actually happening in the market, the price action. We saw in the case of the JGB, not that I can read that, but obviously the earthquake and the government response to it. The intermarket relationships within that rally, well, intermarket relationships, I mean the interaction of the bond markets, foreign exchange, commodities and stock indices, and the extent to which they're cohesive or they diverge. Again, in the dollar-yen examples of the earthquakes, we've seen the market driven by JGBs and Nikkei, dollar-yen, but also yen crosses, leading to a significant move. Believable? I think it's believable. But it's not based on what happened in the earthquake, sadly, God forbid. It's based on the interaction of the fundamentals, intermarket relations, technicals, and sentiment since. It's got a process going that has created similar patterns. And the evidence for this, the evidence for that approach, the evidence for this presentation even, is in the price action. Now, I have actually got fractals for the NFP today. What we do is we do look at NFPs, FOMCs, any fundamental event to see what the market's done in that similar situation before. And what it actually said. No, there's a lie detector going off. What it actually, this is the last example I've got of the last currency NFP. That's pretty close. I go on, sometimes I find people who can see fractals easily and some people can't see them at all. I don't think it's difficult to see that they followed it very closely. Going into the NFP today, I was short S&P, short DAX, looking for a gold rally. It was no one, I certainly didn't anticipate 35k, I still can't believe that. Something's gone on there, but anyway. But the price action, the fractals were saying, May misses, doing what it's doing. My worry, actually, incidentally, is being short S&P, talking to you now, it actually says previously in May, miss, it actually starts rallying now. So, anyone know where the S&P is? And if I start sweating, you know why. It's not because it's hot in here. Okay, so that's individual economic events, looking what's happened before and then looking at what may happen before giving a particular result. But you can see also in the longer term, it still also applies. And central banks, the last time they raised interest rates, or last time they raised interest rates, I might lose the mic here, the red line, back in December 2015. This is what happened on the first time they raised rates in the tightening cycle before, in each and every case. Counterintuitive, yeah? I mean, you would expect that the US raises interest rates, the dollar will go up. What does it do? It goes down. Same time. Each of these is the last 4 times. I haven't just picked 4 out of the last 20. This is the last 4 times. Dollar yen has gone down. Now, given what it does, given what it's done today, you would expect it to do something different, but that's what it's done. And what is really interesting, this is our earthquake example. Now, I'm not going to go so far as to say, well, they raise rates and then there's an earthquake, or they raise rates 4 years after an earthquake, because I wouldn't begin to believe that. But what is really interesting in this 1999, and you'll see this recurs a little bit, is 1999, okay, the US raised interest rates, but there was an Asian crisis before. That Asian crisis led to a collapse in the oil price. And then the US raised rates, and it does the same thing. It's uncanny, yeah? But why? Well, there's 4 factors. Fundamentals, intermarket, technicals, and sentiments are combining. And part of that same story, 1999, going back there, those people follow me on Twitter. In fact, this was a tweet I sent out down there. I'm sure you can see that. It was about gold. This is the price action of gold up to last January compared to 1999. Again, 2 months after they raised interest rates, gold rallies again. Now this was a signal we sent out on the 25th of January, actually tweeted in public, buying back a large amount of short-dated calls for this potential historic. This is the history. This is the current price action back then. You see where it went to? I can't show you. What does it look like? I wouldn't go so far to say it looks 1304, which is a high so far, but it's pretty close. And where's it now? Where's gold? That was what caused that rally, was what was called the Washington Gold Agreement. Now, there's been nothing like it recently, but it was after the first time they raised interest rates in the new tightening cycle. And what is even more unbelievable, and this I mentioned earlier, anyone who's on the NFP fractal, my favourite trade of the year is oil. Now, again, this is going back to earlier in the year, 79 days after the gold rally, oil started following the same price action. That's pretty amazing. Oh, it's probably just coincidence. But back in 1999, the same price action again. What happened in 1999? OPEC cut production, and it followed suit. Which is why we had a target of 45, a minimum target of 45 by May, with potential, if it follows gold, that volatility of 75 to 78. And yes, I'm still long. Okay, intermarket relationships, oil, that's not a currency, but dollar Canada is a currency. And if you compare, we all know about the relationship of Canada to oil. You only needed to trade dollar Canada in January to realise that it was oil driven. But going back in history, you can see it did the same thing back in the 90s as it did recently. That's dollar Canada compared to an inverted oil price. And it's not just similar, so you know they're moving together. They move out of sync. Sometimes it'll be 10, 20 days out, or also 48 hours. So looking at one compared to the other, looking for the correlations. People expect correlations to work in time, but actually what you should be comparing in correlations is structure's price action. Because when the price action is similar, it doesn't matter if it's tomorrow or the day after. The price action is similar, reflecting the same movement of positions in the market that will have the same result, potentially. And that's, I think, of all the gifts that markets give us, is that markets don't move very often simultaneously. They do on days like this, but generally they move in step. So if you miss one market, if you miss buying gold, then 79 days later you had an opportunity to buy oil. And within, similar to that, the S&P is following a very similar path. Euro sterling, you wouldn't believe this one, I find it hard to believe. Euro sterling has followed dollar Canada, which is a bit hard to believe, and I think Brexit is going to break down that driving factor as well. And anyone trading Aussie gold, Aussie will know, anyone who follows me will know that we've caught the move down based on what what the Aussie did 79 hours previously. No, 279 hours previously. So the evidence, that's the evidence about markets relating to each other. And technical analysis, well, I'm sure you've seen many people today talk and show some great strategies based on technical analysis and how successful they've been, and they probably have been. But also, you need to know what technical formations work, how and when. The classic, I love using this example of head and shoulders. Do you know that head and shoulders work on average the majority of the time, but only just? They work more, they're successful in US and Asian markets, and they tend to fail more in European markets. Most notably the German DAX, who fails 73% of the time, which is a powerful indicator in itself. Anyone who knows me knows I use Elliott Wave, partly because Elliott Wave brings together the fundamentals, intermarket relationships, technicals, and sentiment, or what we call fits analysis. Most notably, as we saw with dollar Canada, that fifth wave blowout is very similar to a commodity type market. And retracements. How many people here use Fibonacci? Okay. And you get your book out, it says 61.8%, golden mean, cool number. I'm looking for that correction of 38.2%. Do you know the market that you trade retraces that? Do you know how many times it's retraced it before? Evidence-based analysis. If I were to tell you that in a fundamentally driven market where sentiment is high, dollar-yen tends to retrace only 23.6% to 38.2%, but in a technical market it will trace more than 61.8%, that's worth knowing, isn't it? I think it's worth knowing. Evidence-based analysis. So when you have a pundit who reasons deductively, as many pundits do, and say US rates go up, dollar goes up, then just turn around and say, where's your evidence? Where's your proof? Or say it to yourself. Whoops, no, that's fine. Take that classic example of head and shoulders. People think I don't like head and shoulders. I love head and shoulders, but when they're in the right place. Talking about history repeating itself, some of you won't recognize this chart because it's never actually existed. This is the euro dollar. This is actually dollar mark. It's a synthetic euro dollar. Beautiful head and shoulders. European market, did it meet its target? No. That was as the euro was born, it rallied, after it sort of initially rallied, and we're in this stunningly similar pattern. Hence why it's called Pandora's box. We've followed it for a very long time. The reason it's called Pandora's box is because we thought the move would be based on a Brexit scenario, which it didn't happen, but the price did. I'll come back to Brexit in a while. Okay, I'm not going to go into this in too much detail, but this is combining the fundamentals, the fits, if you like, into an Elliott Wave structure, and this will be posted on the new matrixtrade.com website. I use this a lot. I refer to this. I have a far more detailed version of it, but I refer to this quite a lot because it helps me tick the boxes. If I think this is a fundamentally driven market, I need to see the fundamentals. I need to see the correlations. I need to see the breadth of the move. You need the sentiment to be consistent with that. Likewise, at the end, you need the market, the technicals, everything to break down and be taken over by euphoria. Dollar Canada, I love that example, dollar Canada. It is sentiment that drives price action, robotic or human repeating price action. You go back to 1920s, anyone heard of Jesse Livermore? If you haven't, then I strongly recommend reading the book, and also the recent biography, who's by the guy whose name escapes me. He basically said that markets don't change. Pockets change, suckers change, stocks change, but also humans don't change, and that's why prices, trading, price action repeats itself. I wouldn't say it goes so far as to say price action repeats itself all the time, because I'm not a predeterminist. I don't believe in mystic movements and whatever. Benoit Mandelbrot, I don't know if you've heard of him, but he was a brilliant mathematician and physicist who got into also saw repeating patterns throughout life, even through interference on telephone lines, and saw the fractal nature of so many things in life, and actually said it exists in markets. In fact, he was one of the people warning about the stock market crash in 2008 based on previous price action, and it's one reason why at least the Bank of England thinks what I'm saying makes sense, because they did a study into what caused the 2008 crash, and they came out with the view that markets do exhibit fractal properties, that they do repeat themselves, and that where it becomes increasingly complex, it can resemble price action at a later date. Staggering, eh? This is, of all the things I look at and have looked at, relatively new things, this is the most staggering part for me. This collection of markets or lines, starting with, say, BHP, an Australian share, into the German DAX or Hong Kong index, UK FTSE, Japanese Nikkei, and even the American markets are following a very, very similar pattern. This is not happening together. They're not moving in sync. They're moving at different times. So if you can identify one market that is leading, that it may well continue into other markets in the same next session. In other words, if a market closes strong, let's say, take the current example, market sells off. Sells off from the open in New York, then look what Asia does. And see if it follows a similar pattern, because those guys in New York and robots are facing similar conditions to those in Japan and robots as well. So essentially that's what matrix market looks at. It tries to identify what markets are being moved by what's, that fits analysis. But because of sentiment or what driving a market, we try and sift what is really moving it. So changing the fits analysis to sift. Neat, eh? But it's by using history, by looking at what's happened before in similar circumstances, that we can identify higher probability trades that shifts the odds in our favour. Which takes us, I won't go into much detail on this because it's been a long day. But that's the analysis. I've talked about the analysis and what drives markets and how we can best use what are some clearly well-developed techniques, but actually evidence them and see what will actually work and improve our trading. We trade what is really driving the market. It's no good trading using a sentiment-driven model when in fact it's a technical market. This is one of the metrics we use, but by identifying what is driving the market, by finding the techniques that are working best, that have worked best in similar circumstances, therefore you can identify a better trading strategy that's more likely to work, you get a higher probability, you can identify your risk return, you get a higher payout. And if you get a higher payout, you can leverage more. Evidence-based trading, not just evidence-based analysis. Essentially what this is doing is taking qualitative analysis of what you've heard a lot of today, but applying quantitative techniques. If you like, it's a shortcut to discipline. And we all need discipline. Particularly on June the 23rd. Our earthquake. Is it going to be an earthquake? Are we going to Brexit? Or are we going to regrexit? Yeah, you can tell I've done politics, haven't you? There's a bit of spin doctrine going on, but there's a reason for calling it regrexit. And I'll show you in a minute. But, okay, have we been in a situation like this before? Have we in 1972, when we went in 1975, when we agreement to differ, when we voted to see if we'd stay in? That's very similar. Price action doesn't match, sorry. Okay, let's go to the bar, shall we? Later, 1992. Do you remember 1992 when Britain left the ERM? Sterling was pinned to 3 00s, sterling mark. Well, funny, though. This is euro sterling, again, a synthetic, obviously, before 1999. But look, this is something we were looking at earlier in the year. Same price action going into it. Now, you will, I know I am politically involved, or have been, and so knew the Brexit referendum was coming up. I had this chart that we're going to leave. Can't believe it, but we're actually going to leave, because my chart says sterling's going to have another crisis. But hang on, we've had the crisis already. What does that mean? It means that, in fact, this fractal isn't necessarily a UK leaves the European Union. It's actually saying it's a crisis, sterling crisis fractal. It actually is probably more likely, a sterling uncertainty, a systemic risk fractal. But anyway, forgetting the big words and whatever, what does it actually say? This is quite interesting, I think. But it says it's a buy. It's retraced from 81.10, which is long-term downtrend, in a 3-way corrective pattern, like it did before, back to the breakpoint, head and shoulders, that worked. Yeah, it's a European market, but it still worked. 80-40 with this head and shoulders target. Three-way pullback, Fibos hit, C equals A, perfectly, bang. So what is it saying? We're now going to go into the vote. If you track it by time, you can't always use time, as I said before, it's sometimes misleading. But it says this is where we actually have the vote. So we're actually going to, Euro sterling will rally and then strengthen probably on the result before going back to the high. That's why I don't know if you were here for the NOP, I picked up on what someone said before about the counterintuitive argument, that if sterling actually stays in the ERM, you'd think sterling will do that. Well, in actual fact, you could argue that it is actually better for Europe, for Euro, if we actually vote to stay in. Now, in this instance, obviously, it held the red line, went back to the highs, held that trend line, and came off aggressively. So, okay, that's a one-off. It may not happen again. No, it's true. But hang on, it also happened in 2002. Does anyone remember Gordon Brown's 5 economic tests? The convergence tests? Vaguely, yeah. I try to forget as well. Same price action. We've had the crisis already. We've had the talk about the possibility of going to the European Union, going to the euro. That would have been the crisis. And it's pulled back to the red line. Now look what happens. Oh, okay, this is rubbish because look, this says it goes much higher. It actually says it trades the range. Both of them actually say Brexit has already happened in terms of an impact on the market, and that we're more likely to trade the 75 to 81 range as a pivotal range, and then there'll be other factors because both of these factors say it goes either way. You know, and if it goes either way, what do you do then? Are you going to buy it or sell it? Well, you don't trade that. If that's what's driving your market, then it's a 50-50 play on that alone. But I mentioned about Brexit. Brexit is the closest parallel to what we're going through now. Okay, so anyone remember what happened in Brexit to foreign exchange markets? Kind of think we should really. I kind of was a bit surprised I didn't know that off the top of my head. Well, this is what this is a euro chart. Euro-dollar chart, so the best match to that would be conceivably sterling. Yeah, does that look like a cable chart? The last, it's 100 days before and after the referendum. Obviously, the about new macro, innovative tools and approaches about fits on matrix. We'll be giving fits a score so we can track the right type of techniques at the right time. We're also talking about how we trade it. But in the next 3 weeks, we'll be looking at charts like this. This is a euro-dollar chart 10 days before the Brexit vote, or the Grexit vote, and therefore we'll look to see if it's a map. And if it follows it, well, I'll be trading it. And if it doesn't follow it, I won't trade. Because I'm looking to find higher probability trades with good risk return, because that's the name of the game. Questions? Yeah.
Correlations with the output.
You mean to have I can?
Yes.
The question. Sorry, I should remember this technique of repeating the question because it gives me time to think. Is what the gentleman is asking, is the price action the same now as it was for the Scottish referendum, given that it's a similar political event? First place I looked. No, it's not. I agree with you. The logic is right. That's the type of logic we use. It is attempting to take the real world and take what we do in technical analysis and the relationships between markets and what drives the market and make it real. So it's not traditionally, there are traditional techniques. You like it's traditionally new and revolutionary old, but it's basically just restating common sense, in my humble opinion. Any other questions? Yeah.
You know, Greece was actually a crisis before the referendum they had. It's way different to what we're going through.
Absolutely. I couldn't agree more. But when you look at similar, if you were to, of course it's different. They speak a different language. I would argue that Greece is a continental country and the UK, showing my colours, I'm going to vote to stay in by the way, is Anglo-Saxon. I would love to come out. Very different. You can't draw the parallels too strongly, but it's a possible comparison. So this is what I do, or we do. we look at similar situations, and then the price action's the same. And it starts to say, okay, well, that's rubbish, you can't believe that. And then it starts following, and I'm making money, and I'm right in the wrong market, not wrong in the right market, you know, and that's the name of the game. So, yeah, good question. Any other questions? It's been a long day. Well, can I thank you on behalf of matrixtrade.com, a new company. It's a culmination of lifetime, but Ken, I thank you for coming today, for sticking through the day to hear me. I'd also actually like to ask you in joining me in thanking Kareem and AudaCity for, I think, a pretty professional outfit and performance today. So thank you very much indeed. Appreciate it.